Welcome to the monthly wrap covering the equity market pullback amid coronavirus. Is it a buying opportunity? What you need to know about reporting season and what to watch next week. Well, as we've been reporting, the Aussie share market has taken a coronavirus hit, erasing most of this year's gains and falling from record highs after the ASX 200 lost 6% just in the first 3 trading days this week. That's at the time of recording. So that means the market is now back at early January prices. Even though Australian corona cases are minimal, 8 have the virus, 15 have fully recovered. The global travel bans, quarantining and shutdowns of some global cities is causing market concerns. And that's why global growth forecasts are slowing. And it's also taken a hit on commodity demand, pressuring iron ore and copper prices, which is also why our Australian dollar is now trading at fresh 11-year lows. Over in the US, equities too have stumbled from their record highs to a 12-week low, as the US Centre for Disease Control warned Americans to prepare for potential disruptions, such as school closures. While in Japan, there's whispers the 2020 Olympics could be cancelled, particularly as the World Health Organization flagged this outbreak has pandemic potential, telling all countries to prepare. And let's look at the numbers. Well, our energy stocks have lost the most year to date, 13%, after the oil price dipped to the $50 US mark for the first time since over a year, as the outbreak is dampening oil demand. Meanwhile, our healthcare sector continues to deliver the goods, rising 9%, helped by the likes of CSL and Ramsay as they're trading at all-time and multi-year highs. To the biggest year-to-date gainers. Well, despite the travel and tourism sector taking a hit, IDP Education rose 34% year-to-date to $23.08. IDP helps international students study here and reported stronger than expected profits, with student enrolments rising. It's also seen a recovery from the coronavirus sell-off and was upgraded by several brokers. Morgans, Goldman Sachs and Morgan Stanley say it's a buying opportunity, and Goldman's is targeting a price of $25.40. Another shiner, gold producer Silver Lake Resources, SLR is the ticker code, up 30% to $1.74, hitting 7-year highs, as did the gold price, as investors continue to seek out diversification and safe haven assets. Silver Lake's production beat expectations, and it's flagged high sales and lower costs ahead. The market loved hearing that, which is why Macquarie now thinks its shares will grow further to $2. As for the bearish stocks, Penfolds owner Treasury Wines drank the biggest year-to-date loss among the top 200 stocks. It's down 32% to $11.01 after downgrading profits again, admitting sales have been significantly hit by the virus outbreak, particularly as 40% of their sales are from Asia. And sales are likely to be $11 million lower this year. That's according to Citi. And infrastructure group Downer is down 26% year to date to $6.05, flagging this year's profit will hit $300 million. That's better than last year's result, but weaker than expected. And that's why their shares are now trading at 2018 prices, with a major investor buying the dip. It's also a buy stock for Citi with an $8 price target, as it's diversified across transport, utilities, rail, and its recent spotless purchase. Now diving into reporting season that officially wraps up this week. Well, so far results have modestly or mostly been weaker than expected, with resources dragging while banks mostly beat expectations, with Bendigo and Adelaide Bank and CBA delighting. Notably, Citi upgraded Janice Henderson to a buy and upped Cleanaway Waste Management's price target. So what's next? Well, the RBA meets next Tuesday. 11% of economists are expecting rates to drop to 0.5%. And international or US and Australia's import and export data is out next week for January, so that'll be closely watched to see how corona has taken a hit. Also look out for jobs or non-farm payroll data in the US. And more broadly, what should investors keep in mind? Well, one, as the World Health Organization ambassador Jet Li said, coronavirus knows no borders. So this is why some analysts are expecting this to cause a stock market correction, as short-term company earnings and outlooks have been downgraded, while some are expecting a recovery in GDP and the stock market in the June quarter. So too, look at your investments, and diversifying has never been so important to even out the market kinks. We know balanced portfolios across local and international shares, fixed interest, property, have all outperformed and evened out market bumps over the past 10 years. And ETFs remain a cheap and easy way that investors are getting access to international shares, fixed interest and bonds. So for more on ETFs, check out Bell Potter's ETF report. And thirdly, remember the world's best investor, Warren Buffett, says despite these scary times, think about the companies that you're invested in and are they going to be in business in the next 5 to 10 years? And that's the key to a good investment. Buffett also survived many pandemics, says he's not selling and is holding and is more likely to buy. And this is what we've seen with our clients as well, as our clients have been buying the dip in the right stocks. And lastly, consider taking advantage of those known market trends, like investing in defensive sectors like healthcare that outperform when the economy cools, and sectors that do well when rates drop, like property. And that's plenty to sink your teeth into for now. Don't forget to join us each and every day that the market is open for the morning bell. Take care. Bye for now.